It's the Inside Scoop Virginia, all the news Virginians want to know. Now here's the host of Inside Scoop Virginia, George Burke.
Welcome to tonight's edition of Inside Scoop Virginia. We're going to take on an issue that has created certainly some controversy down at the state capitol in Richmond, and that issue is payday lending. There are two distinct views on the issue. On one side, you have opponents of payday lending saying they either want to put a cap on it, calling it an interest rate, or they want to just eliminate the services that payday lenders provide in Virginia. On the other side, you have supporters of payday lending and certainly folks in the payday lending community who obviously want to stay in business here in Virginia, number one. And number two, they're looking for a compromise. It's unclear at this point whether the opponents are going to compromise. It's my understanding that the governor has sought a compromise. Some of the legislative leaders in both the House and the Senate have sought a compromise. And we'll just have to see how that plays out in the legislature, both in the General Assembly and in the Senate. My guest today is a representative of one of the larger corporations that provides payday lending services in Virginia, Advance America, and his name is Jamie Fulmer. Jamie, welcome to the show.
Thank you very much, Mr. Burke.
I think there's a lot of different thoughts among Virginians and among the politicians who are working on this issue as to what payday lending is and what type of services are actually provided to our citizens. It may surprise some of my viewers, but the fact of the matter is, certainly I have some questions. I think that there's a place for payday lending in Virginia. There are many people among our citizens who, for whatever reason, have bad credit or no credit, and they face an emergency situation, whether it's buying gas or oil to heat their homes, whether it's paying a car payment, whether it's a medical expense, whether it's electricity. But they've got an issue, they've got a problem that needs to be dealt with immediately, and this is an option for them to choose. And I'm not sure there are really any other options available for folks who are facing those kind of difficulties. So Jamie, I'd ask you right off the bat, describe the payday lending product. What is it? I need a loan. What's the process? What are you providing? What service?
Well, simply put, Mr. Burke, our product helps consumers who, for whatever reason, find themselves between paychecks with some type of unbudgeted expense, whether it's a car that they use to get back and forth to work breaks down, or they have an unexpected child care expense. This product helps them bridge that gap, and we provide consumers with a product that they like. We provide a product that consumers have overwhelmingly used responsibly, not only here in the Commonwealth, but all across the country. And we have a product that consumers are overwhelmingly satisfied with. And so, our company, which operates 2,800 payday advance centers across 35 different states and 142 here in the Commonwealth, it takes great pride in the services that we provide to consumers, and we exist because consumers see this product as a rational, cost-competitive alternative to the other options that they have. And our customer is not without other options. Our customer, on average, makes about $41,000 a year. They have a job. They have an active open bank account. About 90% of them have a high school education. And of that 90%, about half of them have college experience, about half of them own their own homes, about half of them have a credit card. So these are consumers that do have other options, but they see our option as a cost-competitive alternative to those options that they have. I mean, consider what those alternatives are. I mean, consumers can bounce a check, which, nationwide, the average cost of a bounce check fee to a financial institution is about $27.40.
I look at my son's bounce checks; they're $35 a pop.
Right.
Sometimes on $5 spent in a store or something.
Exactly. When I was in college, I had a friend that bought a order of French fries at the local college canteen, and the French fries cost him 55 cents. And he wrote a check to pay for it, and the check bounced, and so he paid not only $30 on top of the 55 cents that he paid to the bank, but he also had to pay another $25 to the college because they had a return check fee. And so, you know, the $15 per 100 that you're going to pay for a payday advance can clearly be the rational alternative to paying over $50 in many cases for a single bounce check. The same thing goes, you know, to paying overdraft protection fees that banks offer. The average overdraft protection fee is about $35. Paying $35 plus for your credit card late fee, paying to have your rent or your mortgage, you know, late fee paid, or paying to have your utility bill reconnected, all of which can be more expensive and can carry negative credit consequences. And I haven't even mentioned the unregulated internet option that exists to folks. If you don't have a regulated brick and mortar option, you're driving them to those more expensive options or to the unregulated internet option. And our consumers understand that. And our consumers carefully consider the choices of you know, they have available to them, and they make the decision that they think is best for them and their families. And you know, we very much support the fact that consumers should make educated decisions and make informed decisions. And our industry has gone to great lengths to make sure that consumers that walk in our doors very clearly understand the cost associated with the products that they've gotten from us, that they very clearly understand the ramifications of using those products. And so we believe that we provide a service that consumers like, and we think that it's important for consumers to continue to have access to this product here in the Commonwealth and all across the country.
I have a couple of other questions for you in that area, but we have a phone call already from Sandy from Woodbridge. Sandy, are you there?
Yes, I'm here.
And what can we do for you today?
Well, I was calling in to let you know that I've talked to people regarding this product that's out there, and it is such a benefit to the people that I talk to. They say that when they go to banks, they have to wait in line for like hours until they get a person to fill out an application, and then come to find out that they are denied. And to be able to come into this type of product and to be greeted, it takes about 15, 20 minutes for them to fill out an application and to come in and to be able to be approved quickly and to use the service over and over to their advantage. And they understand what they're using it for, but it benefits them greatly. And they are like ecstatic when they're, you know, it's so quick for them to come in and just apply. And for this decision to be made for them and they don't have a choice, it just doesn't make sense to me.
Well, that's an interesting perspective, and it's a perspective from someone who I presume you have used the service. Thank you for that call. I don't know, you have any comment on that at all, Jamie?
Well, I think it's important to realize that consumers do use this product because they see what options they have available to them. And you know, we compete more with the fee-based products that banks and other financial institutions offer rather than the loan products. And so what we think is important is that consumers have more options to choose from when they find themselves in this situation, not fewer, and you know, make the decision that's best for them and make it a rational decision. And if somebody needs to use a product that's offered by a bank, such as a bounce check or an overdraft protection fee, that's their decision. But many consumers tell us that they like our product for many reasons, many of which the caller has identified, and so we think that consumers ought to have that choice.
I'm sure we have viewers who have a lot of different perspectives on this issue, and I welcome the calls here at 571-749-1166, and we'll put you on the air. What's going on in Virginia? Obviously, you've been spending some time in Richmond, as one would expect, protecting your interests. Give me an overview of what you see going on in the General Assembly right now. Obviously, the issue has not hit committees yet and hit the floor, to the best of my knowledge. I try to keep tabs on what's going on down in the General Assembly. But it's certainly the topic of much discussion. There were a bunch of people running around from both sides on Citizens Lobby Day and some of the other days. As I said earlier, the governor has, you know, said try to get some kind of compromise, and some other legislative leaders have said the same thing. Give me your perspective on what's going on in Richmond, and also I want to get into some details a little later in the program on what's in this compromise versus the all or nothing approach.
Right. Well, the Commonwealth is one of 38 states that has enabling legislation that regulates this product. The law was passed here in 2002, and so our company has been operating under state law since that time. And what is happening in the General Assembly here is that there is a move to reform this industry and provide additional regulations, which we're supportive of. We think it's important to provide reforms that provide additional protections for the small number of consumers who may misuse this product. And make no mistake about it, not unlike any other credit product out there, whether it be a credit card loan, a home loan, a car loan, what have you, there are a small number of consumers who for whatever reason, misuse this product. And so we are supportive of regulations that provide additional protection for those consumers. But what we don't support are efforts to either directly repeal this industry or effectively repeal this industry in the terms of some type of rate cap.
That was my question. A question I had. The opponents of this argue that it's some exorbitant number, 300% or whatever, based on the $15 fees. Are they recurring? Is it an interest rate or is it a fee? How does that part of the process work?
Well, first of all, our company and our industry goes to great lengths to provide consumers with all the information related to the costs associated with this product. That includes the cost, the fee cost, as well as the rate cost that they pay. And there's been much talk about the 391% APR. And consumers, quite frankly, tell us that they're less interested in the APR cost of a product and more interested in the real-world out-of-pocket cost of the product. I mentioned earlier that we compete directly or more directly with fee-based products rather than loan-based products. And if you applied an APR calculation to those fee-based products, the bounce check, the overdraft protection fee, the credit card late fee, they would carry APR calculations of 700 to 1,300%. And the Payday Advance product has a 391% APR, but in order to pay that APR, you would actually have to take out a 2-week loan every 2 weeks for an entire year. That's not how consumers use our product. Our consumers use this product for a set period of time, and they like it because it's a set fee. It doesn't carry accruing interest or any additional late fees. And if you pay us back within that 2-week period, you've paid $15 per 100 that you've borrowed. And consumers clearly understand that $15 that they reach into their pocket and pay for our product can be less expensively than paying the $50 that they reach into their pocket to pay for a bounce check.
And they have access to something quickly.
And they have access to something quickly, and it's a convenient product that they like.
When we come back, there's been one of the things we've seen in the news in the last week or so is that one of the companies, I guess they're a competitor of yours, Check and Go, was recently fined $100,000 for violating state regulations. I believe they were fined by the State Corporation Council. So I wanted to raise it before we go to break, give you an opportunity to think about it a bit, but I'd like to know what went on there, at least from your perspective, because obviously, certainly you're representing your company, but you're also representing this industry. So we'll see what's happening there. We welcome you to hang on. Call us at 571-749-1166. My guest today is Jamie Fulmer of Finance America, and our topic is payday lending. Thanks for watching. We'll see you in 2 minutes.
How far would you go to help someone? Would you go to the end of your driveway? Would you cross a street? Would you cross an ocean? To a place 6,000 miles from home? And how long would you go? Would you go for a week? A month? A year? Would you go for 2 years? Would you go if you could use your knowledge to teach someone? And in the process, maybe learn something yourself. Life is calling. How far will you go? Peace Corps.
James, don't forget your helmet.
Will do.
Not a helmet. Your bike helmet.
Oh, okay. Hi, I'm James Thrash with the Washington Redskins. On the football field, a helmet is an important piece of equipment. I also wear another helmet that's just as important. A bike helmet. It's the most important piece of equipment you'll have the next time you're out on your bike. Wear yours and make sure your kids do too. Safety first with the Skins.
Monica and her friends want you to know that you should never get near a dog when it is eating, playing with a favorite toy, or sleeping. It's really important to make time for exercise and games and keep your dog's vaccines up to date. Never leave a dog in a small, confined space. This can make dogs aggressive like Monica. If you follow this advice, you and your dog can play safely and happily together.
Welcome back to Inside Scoop Virginia. I'm your host, George Burke. My guest today is Jamie Fulmer of Advance America. Jamie, so we got a company in this business. The opponents are raising the red flag. $100,000 fine from the State Corporation Council for violating state regs. The opponents say this is a valid reason why we need to clamp down on these folks. How do you respond?
Well, I think it's important to look at this from a perspective of and I don't know the details of what happened in the check and go situation, but what I do know is that that's specifically why consumers need a regulated product in the Commonwealth. If our product is regulated by the Commonwealth, is audited regularly by the State Corporations Commission, and consumers have a place where they can complain when they have a situation that they don't feel like they've been treated fairly. And quite frankly, our industry this year, or excuse me, in 2007, there were, I think, 68 complaints against licensed lenders here in the Commonwealth. And consumers need to have those protections in place so that if they have a problem with a product, they know where they can turn. And I think that shows that the situation that you mentioned, that shows that the system works. And if you had a problem with an unregulated or an unlicensed internet lender that was domiciled in Grenada or Costa Rica or somewhere like that, they have nowhere to complain if a consumer has been in a situation where they haven't been treated fairly. So we think it's important that consumers have in place a regulated environment where they know where they can go to complain if they have a problem, and they can have the assurances that this is a product that's regularly audited by the state agencies.
We have a question from a caller who called but didn't stay on the line, but their question is, what are the alternative costs of bounce checks, pawn shops, payday loans versus other alternatives?
Well, the payday loan here in the Commonwealth is $15 per 100. The cost of bouncing a check, as we talked about, can be over $50 per item, regardless of the cost. So if it's a $5 bounce check, it's still going to be $50, or if it's a $100 bounce check, it's still going to be $50. And we believe we compete very well from a cost perspective with the bounce check option. The pawn shop option, I think, is one of the few lenders that actually are capped in Virginia. And I believe for the pawn loan, you're capped at 120% rate plus another 60%, plus you secure your loan with some type of real personal property, such as your grandmother's wedding ring or your TV or what have you. And so, again, we feel like we compete very cost competitively with that option. And again, we're not trying to sit here and say that our product is the right product for every consumer in every situation. But what we very strongly believe is that consumers are smart enough to make those decisions for themselves. And for the same reason why you may go to the grocery store to buy your milk, but when you have a situation where you need milk quick to give it to your baby who's crying in the middle of the night, you may go to a convenience store. And so we think that it depends on the situation and it depends on the need. But again, consumers should make those decisions for themselves.
the debate in Richmond is, in essence, there are bills that say cap it at 36%. There are a couple of bills. I mean, there's a bunch of bills. There's got to be more than a dozen easily in the hopper. There are bills that say just kill it outright, repeal the law, get rid of them, et cetera. And then the reforms. There are a number of bills. Mark Sickles has one. Delegate Ware has one. I've seen a couple of others that are reform bills. They're not all exactly the same, but they're these legislators' ideas on how to do it. How do you frame reform?
Well, we're supportive of the bill offered by Delegate Ware. We believe that it provides real protections for consumers and addresses many of the concerns that the consumer critics have about misuse of this product. The Delegate Ware bill includes a cap where consumers could only have 2 loans outstanding at any given time industry-wide. It would include a database that would monitor that so that to make sure that this was in place. It would include a next day cooling off period. So after one loan that consumers got from a payday advance company, they would have to wait till the next day before they could get another loan. It would also include an extended payment plan, which would give consumers the ability at any point in time during their transaction history with us, if they feel like they can't meet their obligation to us and pay us on time, that it would allow them to enter in at no additional cost, at no additional fee, at no additional accruing interest into what we call an extended payment plan that gives them up to 4 additional pay periods to pay off their obligation to us in smaller bites. And so we believe those are a comprehensive series of reforms that directly address the concerns that folks have about this product. And let me mention 36%. Because there's a lot of talk about 36%, because I think it's very important for your viewers to understand what 36% rate cap applied to this industry does. It kills it. It repeals the industry. It bans the industry. Nobody in the industry could offer consumers a loan at 36% and stay in business because we can't cover our basic overhead operating costs at 36%.
What does that equal in terms of somebody who takes out a $300 2-week loan?
Well,
if it's at 36%.
Well, let me do the math a little bit simpler because I can state it better this way because I'm not a math major. But on a $100 loan, for example, 36% on a $100 loan equates to $1.38 that we could charge for a 2-week period, and so that breaks out to less than 10 cents a day. We can't meet any of our payroll costs. We can't meet any of our cost of paying our light bill or paying our rent or anything else, let alone covering the cost of unsecured short-term credit for a 2-week period. So essentially that would put us out of business. I saw something the other day that suggested that the average payday lending store in the Commonwealth on a 36% APR would lose about $120,000 a year, because the cost, you couldn't cover any of your basic costs. So it wouldn't even be a matter of making less profit. It would be a matter of losing over $120,000 a year operating under a 36% rate cap. So what happens is the unintended consequence of a rate cap, while it sounds good, is that it would drive the regulated brick and mortar payday lending industry out of the state of Virginia. And so, folks who depended on this product when they found themselves in a time of need would be left without this option, and they'd be forced to turn to the more expensive options or to the less advantageous options. And we don't think that's what consumers in Virginia want. Last year, over 450,000 consumers used this product, and overwhelmingly they used it satisfactorily. And so we think it's important that consumers continue to have access to this product. And 36% very clearly would cause this industry to leave this product. And what happens is that if you drive the industry away, you've done nothing to address the need for the product. And so all you've done is taken away the option, and you've driven them to more expensive options.
The opponents say, well, credit unions can fill the void, even churches can fill the void. How do they do that? I mean, my understanding of credit unions is you have to belong and the like, and I just haven't seen churches as a lending institution before. It's a charitable institution, yes. How do you respond to that? Because there's certainly some church leaders who are opposing the reform bill and pushing to basically kill your industry. How do you respond to that?
Well, we think that credit union products are great. We think that churches that want to contribute to their parishioners in a time of need, we think that's great. But again, we don't think that those products meet all the demand for short-term financial help. And you're right, credit union products have different dynamics. They may carry minimum membership requirements. You may have to be a member of a credit union for 6 months. You may have to have a certain bank account balance. You may have to pay additional fees. You may have to do various other things. And so, those products, while they may appeal to many consumers, they may not appeal to all consumers, and certainly there may not be enough providers of those products to satisfy the demand for the product. In a perfect world, nobody would have need for small amounts of short-term credit, and if they did, they would have a family member they could turn to, a friend they could turn to, or a church they could turn to. But the reality of it is that for whatever reason, that doesn't fit every consumer in every situation. And so we do provide a service to consumers, and we do charge a fee for it. But we provide a product that is competitively priced in the marketplace. If there were products out there that were provided to consumers less expensively, consumers are savvy enough to know where those less expensive products are, and so they'd be gravitating toward them. But the fact of the matter is there is nobody out there offering a less expensive product. The other item I would point out is that there's no question about the demand for this product. And so if somebody thought they could go out and offer a product less expensively and pick up in market share what they may trade off in revenue, they'd be doing it too. But the fact of the matter is nobody's out there offering a product less expensively. And so, we think that the marketplace in that respect is efficient, but we welcome everybody into this marketplace. And if they think they have a product that consumers like, then we have a competitive issue that we have to deal with. But we don't think that the state should regulate us out of business because they're taking away an option for consumers.
I want to discuss that a little bit more because there are a couple of states around us that have, in fact, killed payday lending within their borders. At least within their state. That doesn't stop people from using the internet options and the like, but I will do that in the next segment because we're drawing to a close. But just very quickly, I heard something about auto loans and student loans and other mortgages and some other types of loans are in a similar category. What's the story with them? Are they capped, or are they, how do they relate to payday lending? Obviously, you don't go to a payday lender to buy a car, but what's the connection there?
Well, there's a lot of misunderstanding about this in the Commonwealth. The payday lending product is one of 3 loans that actually has a cap applied to it. It would be the payday lending product.
Let's get to it right after the break. I wanted to get that started. Thank you for watching. We urge you to stay. We've got a half an hour left, and we've got a lot of ground to cover. My guest is Jamie Folmer of Advance America. You can reach us at 571-749-1166, and we'll see you at the back end of these PSAs.
Go to jail for a gun crime, and your family serves a sentence with you.
I'm Bob Costas, and I've been broadcasting sports for a long time. Much of what I do is ad-libbed, but still one of the most important aspects of my job is being able to write. Narrations, essays, commentaries. It's essential to express those thoughts and concepts clearly and concisely. Good writing is essential for almost any career. And with today's advanced technology, the National Commission on Writing reports that the need to write well has never been more important. Writing is everybody's business.
Sure, my neighbors Gene and Louise, they may be superheroes with superpowers, but that doesn't make them so super at saving energy and money.
Honey?
I may not be able to harness the power of the elements, but I save significant cash and help the environment with appliances, electronics, and windows featuring the Energy Star label. So discover your own energy-saving superpowers. Go to ase.org/consumers.
Mom, Dad's making fun again.
Now back to the Inside Scoop Virginia. Call in live and let your voice be heard. Here again, your host, George Burke.
Welcome back to Inside Scoop Virginia. My guest is Jamie Fulmer of Advance America. When I so rudely interrupted you for a break, we were talking about how payday loans compare with auto loans, student loans, and some other financial products. So please, continue.
Well, as I was saying, the payday product in the Commonwealth is one of 3 loans that actually has a cap. Our loans are capped at $15 per 100. The other loans with a cap.
And that's by current law?
That's by the current law that was passed in 2002. The other loans are the pawn loans that I mentioned, which are capped at 120% plus 60% plus the security of real tangible personal property. And then the third would be small short-term consumer finance loans, which are capped at 36% plus additional fees that can be charged. And after $2,500, those loans have no caps. The examples of loans that are uncapped in the Commonwealth are credit card loans, installment loans, home loans, loans on your 401k, loans when you go buy a washing machine and dryer at Sears. All of those type of loans carry no caps. And so, you know, again, we have no problem with the notion of capping the rates on this industry. What we don't want to see happen is that, you know, we're capped to the point of extinction and capped to the point where we can't afford to offer this product.
Why do you think that there is so much interest in dealing with your industry, but not some of these other consumer loans and the finance companies and even the credit cards? I mean, why are they coming after you and not after them?
Well, you know, that's a good question, and I don't really know the answer to that. I mean, I think there are, unfortunately, a lot of misconceptions about this industry, and you know, that's part of our job is to get out and tell the story and stick to the facts and tell people the facts as it relates to this industry, because, you know, consumers like this product, and you know, it's somewhat unusual for folks to try to eliminate a product that very few people complain about, that overwhelmingly people use responsibly, and overwhelmingly people like when they find themselves in a time of short-term financial need. But, you know, we think that, you know, it's important to have this discussion, and we certainly are supportive of additional reforms that we think, and I think a lot of people believe, provide real, meaningful protections for consumers. And you know, we don't want any consumer to be in a situation where they get into a situation where they've abused a product or overused a product. We want them to use it responsibly so that when we loan them money, they'll pay us back, because it makes no sense for us to loan money to consumers that don't pay us back. And so again, overwhelmingly, about 95% of the consumers who use our products pay us back on or within a day or two of when they're due, and ultimately 97% of consumers pay us back. So you know, this is clear evidence that supports the fact that consumers like this product and use it responsibly.
So I borrowed, let's stay at $100. I borrowed, because I'm not a math major either.
Sorry.
And so I borrow $100 and I don't get it back in 2 weeks, but I get it back 2 days later. Get it to you 2 days after the deadline or whatever it may be called. How much more does that cost me?
Not a dime more. If you borrow $100 from us and you don't pay us back, you know, within the set period of time, if you don't pay us back for 6 months, when you come back in and pay that obligation off, you still only owe us the same $15 that you owed us when you borrowed the first original $100. And I think that's part of why consumers like it, because it's such a simple, straightforward transaction. They understand that this product, you know, costs what it costs. And, you know, unlike a credit card or another financial product where there's accruing interest that can change the effective rate of what you're paying, there can be late fees, there can be all these other things. Our product is a simple, straightforward product. And you know, we believe the marketplace exists for simple, straightforward financial products. And you know, again, we're not trying to knock credit cards or credit union products or other products that are out there. But you know, we think consumers should have all the options that they need to make a decision that they think is good for them.
What happened this is sort of a two-pronged question. the District of Columbia capped the rate at 24%, I understand, in the not too recent past. And there are prohibitions in Maryland and West Virginia and North Carolina. The opponents raised this quite a bit, saying, well, the other states around us don't have it, Virginia has it. What happened in the district first, and what about those prohibitions in those other states? You know,
well,
what options do those residents of those states have?
Well, the district passed a rate cap that went into effect, I believe, early January of 24%. And again, you know, the unintended consequence is that lenders who were offering a payday product in the district no longer offer that product. So consumers are left without one choice. In many cases, they're coming to Virginia because they like that product and they want to continue to use that product. In other cases, they're forced to, you know, turn to the more expensive bounce check or the unregulated internet lender or the overdraft protection or any of the other options that I mentioned. In Maryland and West Virginia, there's never been enabling legislation for a payday lending product. So it's just never been addressed, and it never has existed in those states. In North Carolina, there was a law that was in place that had a sunset provision, and that law sunset in 2001, and then later through an administrative action by the Commissioner of Banks there, the product ceased to be offered in 2005. And it's interesting you bring up North Carolina because there's a study done by two researchers at the Federal Reserve Bank of New York, and they took a look at two states where the payday lending product existed and no longer exists, those being Georgia and North Carolina. And what they found was that consumers were not necessarily better off without having access to this product. They actually had higher instances of bounce check fees that they were incurring. They had higher instances of Chapter 7 bankruptcies, and they had higher complaints to the Federal Trade Commission. So it speaks to my point earlier about if you take away the product, you've done nothing to address the need for the product. And I'd point out that when our company was founded back in 1997, there were 16 states that had specific enabling legislation. Today that number is 38, and that's representative of a clear and growing trend toward acceptance of this product, not only at the state level, but at the local level all across this country. And so, we think that Virginia and other places have a recognition that there is a demand for small denomination short-term credit. And we understand and recognize the fact that there's always going to be ways that we can tweak the laws and make it better for consumers, but we don't want to take the whole product away from them.
This has hit the national stage in a couple, not necessarily out of Virginia, but the issue of payday lending's hit the national stage a couple of times. You got a couple of presidential candidates who've talked about it a little bit, and the Congress has passed some legislation which puts some limitations on the military. How do you respond to those types of changes that have taken place?
Well, I think in terms of the presidential election, I think the climate is such that credit in general is being discussed, and I think that folks in both parties are taking a look at how to provide credit to consumers in a responsible manner so that there's not this abuse that we've seen. Look, people misuse the payday product, but that's not unique to the payday product. In many cases, the folks that misuse our product, the payday product is just one element of a whole recipe of scenarios that have gotten them into a situation of misuse. I mean, they've misused credit card products, they've misused their home loan, their car loans, whatever. And so, we think it's important for consumers to understand very clearly the implications and the ramifications of the financial decisions that they make. And, we think that, the responsible use of our product is something that our industry takes great pains to make sure that consumers understand. When consumers come into our centers, they see very clearly in poster size the rates and the fees that we charge for our product. And we also walk them very carefully through that during the customer agreement. We also, as they use our product, we give them a brochure that educates them about responsible use of our product and educates them about the the ways that this product is intended to be used. And then on every, I think, 5th transaction, we give them the brochure again so that we make sure that they understand what they're doing. And you know, so I think that the larger issue is that, you know, we have a situation in this country where folks misuse credit, and I think that's a perfectly healthy discussion. But I think it's also important that we don't eliminate those ways of credit that consumers use responsibly.
What about the military?
Yes, sir.
Specific, you know, I mean, obviously there's been some strictures put on it, and I think we'll all agree that our members of our armed forces do not make enough money.
Right, and I think that's, you know, part of a larger discussion. But you know, folks that were in active duty military personnel, you know, sometimes fit our customer demographic. That $41,000, that you know, educated bank account demographic, and I must tell you that our company has not loaned active duty military personnel for about 1.5 years now, and we made that decision in deference to the Department of Defense after a report was issued that said that the military should not have access to this.
So that was before this law.
That was before the Talon Amendment passed. We didn't agree with their conclusions, and we strongly disagreed with the methodology they used to come to those conclusions. But out of deference to them, you know, especially during a time of war, we felt it was important to take the steps that we did. Unfortunately, our decision and ultimately the law that affected military personnel took away a credit product from consumers that were military personnel. And you know, again, you know, the Department of Defense report that came out that preceded the law that was passed has been roundly criticized by a General Accounting Office study that took a look at this, by concluding that many of the conclusions and the recommendations that this Department of Defense report made weren't necessarily backed up by the findings of the report, and so the industry was completely excluded from the discussions. Industry critics were, used to largely influence this report, and the General Accounting Office study, the GAO study, supported that notion. And so, unfortunately, members of Congress, made laws based on information that didn't provide all the facts that were necessary for them, and the General Accounting Office study supports that.
The opponents say that there hasn't been a full airing of this issue in Richmond and the like. Are you folks trying to hold back on discussion of the issue? It doesn't appear so, at least in terms of your speaking with me today. And I've seen you quoted. I've looked at a bunch of different articles, and I've seen you out there. What's causing, I'll call it constipation on this issue? What's the holdback? Are you guys holding back? Are they holding back? Where's the, and we only have about a minute before we go to break.
Well,
so.
we certainly are supportive of the discussion, because we think it's important to have a discussion about the financial health of consumers. And I think our position has always been that we're more than willing to talk about this issue, and have been very willing to work with folks to try to find reasonable reforms. But we certainly don't support efforts to ban the industry outright, or to ban the industry with a rate cap of 36%. And I think that's ultimately where where we and many of the consumer critics cannot agree on, because they understand that 36% would ban the industry. Even though in many cases they try to promote that as reform, they very clearly understand that that's a ban of the industry. So if you can't go through the front door, go through the back door, and 36% is a backdoor repeal of this industry.
It's, I must admit, it's perplexing to me that folks who often purport to represent folks who may have needs want to eliminate something that can provide, sure, some of them can get hung up in the process, but it certainly assists some people, and I don't quite understand why they want to kill it.
All the news Virginians want to know.
We are coming to a break. Sorry for the rude interruption. And we'll be back in 2 minutes with Jamie Fulmer of Advance America, and we'll get to the bottom of this.
After lunch, but then I saw it later when I was playing in the woods. The next week, I went boating with my grandpa, and there it was. I tried to go swimming, but I couldn't because of my trash. And when I went fishing, well, you can guess what I caught that day. So now I always throw away my trash in the garbage can, where it belongs.
1 in 8 Americans goes hungry. One idea helped change that. A community started a garden that blossomed into farmers markets. 1 in 6 children lives in poverty. One group of women found an answer by opening a daycare center that their neighbors could afford. Today, 36 million Americans live in poverty, but one by one, people are helping themselves and each other to change the picture of poverty to one of hope. For easy ways you can help, visit povertyusa.org.
Every year, 250,000 Americans are diagnosed with Alzheimer's disease.
My fellow scientists and I are working on treatments and a cure for this deadly disease.
Millions of lives are at stake. Alzheimer's disease affects 1 in 3 families.
We're committed to uncovering the mystery of Alzheimer's.
And we're not going to quit until the job is done.
To find out more about Alzheimer's disease, call 1-800-437-2423.
Only through research will a cure be found.
James, don't forget your helmet.
Will do.
Not a helmet. Your bike helmet.
Oh, okay. Hi, I'm James Thrash with the Washington Redskins. On the football field, a helmet is an important piece of equipment. I also wear another helmet that's just as important. A bike helmet. It's the most important piece of equipment you'll have the next time you're out on your bike. Wear yours and make sure your kids do too. Safety first with the Skins.
Now back to the Inside Scoop, Virginia. Call in live and let your voice be heard. Here again, your host, George Burke.
Welcome back. My guest today is Jamie Fulmer of Advance America. We're talking about payday lending. I've learned quite a bit about it. I've been reading newspaper articles for several months now. There have certainly been newspaper editorials on both sides of the issue. Mark Fisher, Washington Post columnist, had an interesting piece that ran sometime last week. Are payday loans a service or a disservice? And I thought overall he gave a pretty balanced view. One of the things he raised, though, was the fact that that the loans roll over. And in my discussion with you, it doesn't appear that that's the case in terms of these fees.
Rollovers, for example, in Virginia are not legal. Consumers can't come in and pay just the fee and continue that transaction. In order to get another transaction with us, you have to pay out your fee, the amount that you owe us completely before you can get another another transaction. And so, that rollover is allowed in certain states, and I believe 11 states are rollover transactions allowed. But for our company, for example, it represents less than 4% of the transactions that we do, and so. Consumers, the rollover transaction that he mentions is simply just not allowed practice in the Commonwealth, and lenders that are regulated by the state don't offer a rollover.
I want to ask a couple of other questions on the national area. Oregon recently imposed a 36% cap. Mm-hmm. And that's being pointed to by some of the opponents. What's going on in Oregon? Obviously, you got business interests there, I presume.
Well, we did. Oregon was a state where our company had 45 centers, and after a rate cap of 36% plus additional fees that you could charge, it made it simply impossible for us to keep our centers open. We couldn't meet any of our basic overhead costs. So, again, the unintended consequence was that you didn't protect consumers because you took away a product from them. You caused 120 people with our company and certainly more industry-wide to lose their jobs. And you didn't do anything to address the consumer need for a product. And so, obviously what would very certainly happen here in the Commonwealth if a 36% rate cap was passed, that the industry would go away. And for example, for our company, there are close to 350 jobs that would be lost industry-wide. I think that would be about 2,500 jobs in Virginia that would be lost industry-wide. And those are things that folks don't think about. And again, all you're doing for consumers is you're turning them to more expensive options. You're turning them to more bounced checks, as the study from the Federal Reserve suggests. You're turning them to the internet product. Which has no protection for consumers, and so we think people need to be very clear about what happens if you pass this 36% rate cap. Because I think if you ask somebody, would you rather pay 391% or 36%? I think anybody's going to say, oh, I'd rather pay 36%. But if you peel back the onion and you say, do you want to pay $15 for, $100 when you have, need for short-term financial help, or do you want to pay $50 for the bounce check? I think that's a very different question. And again, it's all determined by what's out there and available in the market. And, I think that people need to understand that a 36% rate cap means that the industry in the Commonwealth of Virginia would go away, as it has in D.C. and as it has in Oregon.
Critics say that the reforms that are being advanced by the folks supporting payday lending are not real reforms. Have similar reforms been passed in any other states? Are there any other examples of where they've passed reform that has kept the payday lending business alive, provided that service, but obviously added reform, some of which it seems you've already instituted on your own? What's the story nationwide?
Absolutely. There have been other states that have enacted reforms that provide additional protection for consumers without eliminating the product. Florida is an example of a state that's passed reform. New Mexico is an example of a state that's just recently passed reform. And again, I point to the fact that when our company was founded, there were 16 states that had specific enabling legislation. Today, that number is 38. So, states all across this country are passing reform measures and continuing to work to find additional measures to provide, additional protections for consumers. And we certainly, are more than willing to sit down and work and be part of the discussion to provide additional protections for consumers that address concerns that folks have. But that doesn't mean we're supportive of efforts to eliminate our product. And there's a big distinction between the two.
Are the reforms working? I mean, in many states that haven't passed that long ago, are they actually working in those states? I mean, what's the difference? What do you see in statistics? What do you see in terms of the number of loans, that type of stuff? Is there any change, or what has happened with those reforms?
Absolutely, and we've seen it in states. Florida's a good example. We've seen it in other states where you put in these protections and you do help consumers. And for example, there's a lot of talk about use of our product. Our company, which is in 35 of the 38 states that regulate this product, the average consumer uses our product about a little over 7 times a year, and that number has consistently gone down over the past several years. So, reforms do work, and I think it's important, for the folks in the Commonwealth to give the opportunity for a reform to work. And the reforms that we're talking about speak directly to the concerns that folks have about the cycle of debt or misuse of the product or things like that. That would provide a consumer who feels like they can't meet their obligation, 4 additional pay periods at no additional cost, at no additional fee, the opportunity to pay off that obligation. That speaks to it. The notion of limiting the number of loans outstanding you could have at any one time, that certainly addresses many of the concerns that folks have. The next day cooling off period. I mean, it's interesting, you'd never hear somebody, suggest that, you have a cooling off period if somebody wanted to buy a Big Mac at McDonald's. But, that's exactly what we're suggesting that consumers do, that they can't have another product from us for, until the next day. And so, that's basically driving business away from us. But we think that's an important protection for consumers to prevent them from getting into a situation of misuse. And so all those things are real meaningful reforms for consumers here in the Commonwealth. And again, all those things are providing reforms for consumers without taking away the product.
Continuing playing the devil's advocate, you mentioned McDonald's. Critics, which I think that probably payday loans are less dangerous to the heart than McDonald's is, but that's another story. Critics say, and I like McDonald's, critics say there will be more payday lender locations if there isn't a rate cap and if it isn't stopped now, and that there'll be more payday lenders than McDonald's or Starbucks in Virginia. I mean, what's going to happen with the?
Well, that's somewhat of a disingenuous argument. I mean, you're comparing, 2 nationally known, food franchises to an entire industry. You don't compare the number of fast food restaurants to the number of payday loan industry centers operating, because it doesn't serve their purpose. But And I think that's done to create shock and awe in the number of locations. But quite frankly, the number of locations that exist here in the Commonwealth exist because they're satisfying a demand. The State Corporation Commission report shows that the number of locations hasn't grown or hasn't changed substantially in the last couple of years. And so that suggests that possibly the market is built. There's 791 payday loan centers here in the Commonwealth. There are 2,200 bank branches here in the Commonwealth, and you certainly don't hear people complaining about the number of bank branches. So, again, in a free market society, the demand that's there is serviced by the number of providers existing to serve that demand, and so. We believe that we serve a demand for, or satisfy a demand for a product, and consumers like our product and again, use it responsibly.
How, if you had the opportunity to, well, let me phrase it differently. And I'm asking you to look in your crystal ball, and I may be a little unfair here, but what do you think is going to happen in the legislature? I mean, last time we saw some bills up there. At the end, the bill died in the Senate. There wasn't a real agreement, it appeared, among the legislators. What's interesting to me is this is not a partisan issue. There are Republicans and Democrats on both sides of this issue. And so it's not something that may necessarily come under the partisan fire that is brimming in the General Assembly right now after they dealt with that collective bargaining bill, and the Republicans tried to hoodwink the Democrats, and it's that was an unusual display. But how do you see things? I mean, are you hopeful that you're going to see some kind of reform bill this time? Well, and I'm being unfair to you again because you only have about a minute to answer that.
Well, we're certainly hopeful. I'd be foolish to try to handicap what the legislature may or may not do, but we certainly are hopeful of working with folks on both sides of the aisle, as you mentioned, to try to find meaningful reforms, because this is an issue that I think while it gets a lot of press and it gets a lot of discussion in the halls of the General Assembly, I'm not so sure that folks on Main Street are as concerned about this issue as they are many of the other hot button issues that are out there that have a direct impact on their lives. But what consumers that we talk to, they don't want the government taking away their choice, and that's what they're telling us at our stores all across the state, is that they like this product and they don't want the government telling them what to do with their financial decisions, and they don't want the government taking away this choice from them.
Our guest today was Jamie Fulmer. He's a spokesman for Advance America, which is one of the payday lending institutions that operates in Virginia. He has been very active on the issue. It is, an issue that is up for consideration in Richmond. I hope we've enlightened you a little bit tonight on the subject matter. You'll have to make your own choice. Meanwhile, I thank you for watching tonight. We're switching next week. I will start appearing on Sunday nights, and Mark Levine will appear on Mondays, giving me a little more opportunity to grab some General Assembly members who are up for the weekend.